Hi, Rick McBride here with McBride Realty. with your property masters and your 5 minutes of free time. Today, I wanted to discuss a conversation I heard on CNBC the other day. They were interviewing a guy named Cashion. For those of you who watch CNBC, you're very familiar with him. He's on there all the time. He's a Wall Street lifer, often on the channel, and pretty good wealth of knowledge and experience. And he was making the point that interest rates will not be increased as much as was originally believed. The commentators were quick to point out that he's one of the few who made that prediction last year, and they did only raise them, I think, a half a point total the entire year. So his opinion is quite credible. So let's assume he's right, and let's figure out what that means for us, or for you actually. Interest rates are determined by the Federal Reserves. The Fed interest rate is the amount of interest charged by the bank when they lend money to each other, not to you, to each other, from the reserves, and is determined by the Federal Reserve Bank. They will use this rate to slow the economy, speed the economy up. The last 10 years, they just keep lowering it and lowering it and lowering it and lowering it to speed the economy up. Prior to that, they were raising it and raising it to slow the economy down. It's one of the ways that they can control the flow of money. So basically, it's the amount that a bank will pay to borrow money. Banks don't typically have money in their banks. Of course they have some, but most money is held in the Federal Reserve. They add, of course the banks aren't going to lend the money at the price they pay for it. They're going to add points to it based on, before they lend it to the public, to businesses, or any investment opportunities they may run across, whatever it is. But they're going to add a risk premium to that rate based on how risky the investment or the people that they're lending their money to, how risky that is. What does it mean to you? Well, when a bank lends, they base their interest rate on the government T-bill. So basically, that is considered the safest investment on the planet. The Federal Reserve the federal government T-bill. So if T-bill, say, for sake of argument, is issuing 2%, then they say, okay, I can take all these millions and millions of dollars and I can buy bonds from the government and I can make 2% on my money. So now they say, okay, if I lend the money to you, Mr. Person wants to borrow money for whatever reason, then there's a risk involved. You may not pay me back. So what is that risk, and what is my risk premium? Each bank then decides what their risk premium is and determines their interest rate based off the T-bill. So if you have an 800 credit score and you've never paid anything late and you've never defaulted on anything, chances are you're going to get a better interest rate. So let's say the T-bill is at 2% because the Fed funds rate is at 0.75%. Well, now you're probably going to get 3.75% interest rate. Whereas if I'm investing in an investment property and spending $300,000 on an investment property, then I'm more likely to pay 5, 6, 7% because the risk factor is higher. The risk is greater, therefore they're going to charge more for the interest because basically they have to cover their defaults. They're going to say a percentage of these loans default, so therefore I have to cover that cost. Of course, now back to Art Cashion's prediction. The general consensus had been 3 rate hikes of about 0.25% this year, or somewhere between 0.75% and 1% interest rate increase in the Fed funds rate. That would typically translate more or less to the same to mortgage rates. Mortgage rates tend to go up a little bit less, so let's call it 0.75% to 1%. But Art Cashion is saying we will be lucky to have 2 federal fund rate hikes, and more likely we'll only have 1 of 0.25%. So what does that mean? Well, with interest rates hovering right around 4% now, depending on your credit, we can likely expect them to stay where they are or increase very, very, very little moving forward. This will continue to fuel buyers and contribute to the seller's market. Where does that get us? Higher demand, less supply, means continued increases in the prices for the near future. I mean, for the long future, really, but definitely for the next year. We went up 21% last year. Can we do that again this year? I don't know. But maybe. But it is a seller's market for sure, and looks to continue to be a seller's market moving forward. Are you thinking about selling? You would likely be surprised what your property is worth. Let us come out and give you a free market analysis. Have you been pent up in your house for longer than you ever expected to be there? Well, you most likely are free from that ball and chain. You most likely are no longer upside down. Let us get you top dollar for your property or business. Call or text us today at 386-866-1007. Don't miss out on one of the greatest sellers markets of all time. 386-866-1007. We'd love to see you.